So when you're looking at your overhead, we're looking at that 40% best in class. We're always protecting 20% profit no matter what. If your cost of goods sold is higher than 40%, that would have to shave off of your operating expense allowance because we want to protect 20% profitability, right? So you've got 80% play between your cost of selling and your expenses.
Welcome to the Ecomm Breakthrough Podcast. Are you ready to unlock the full potential and growth in your business? You've already crossed 7 figures in sales, but the challenge is knowing how to take your business to the next level. Join Josh Hadley, an 8-figure Ecomm business owner and investor, as he interviews highly successful business owners. Get ready, because you're going to learn specific actions you can take today to help your business reach its full potential and leave a lasting impact on the world.
Welcome to the Ecomm Breakthrough Podcast. I'm your host, Josh Hadley, where I interview the top business leaders in e-commerce. Past guests include Kevin King, Aaron Cordovez, and Michael E. Gerber, author of The E-Myth. Today, I am speaking with Christyne Grey. She is the founder of She Profits Now. And today, we are going to be talking about an infinite financial loop to make your business more profitable. This episode is brought to you by Ecomm Breakthrough, where I specialize in investing in and scaling 7-figure e-commerce companies to 8 figures and beyond. If you're an ambitious e-commerce entrepreneur looking for a partner who can help take your business to the next level, my team and I bring hands-on experience, strategic insights, and the resources needed to fuel your growth. So if you or someone you know is ready to scale or looking for an investment partner, reach out to me directly at josh@ecommbreakthrough.com. That's Ecomm with 2 M's, and then let's turn your dreams into reality. Today, I am super excited to introduce you all to Christyne Grey. Christyne is a distinguished accountant, inventory planning expert, cash flow efficiency coach, certified tax specialist, and the visionary founder of She Profits Now. With a career spanning over 25 years, she has been a serial entrepreneur focusing on the retail industry since her college days. She has dedicated her career to helping high-achieving retail industry entrepreneurs create profitable and impactful businesses through her financially fabulous coaching program and her extensive experience in the financial directorship and leadership. With that introduction, welcome to the show, Christyne.
Thank you, Josh. I'm happy to be here.
I'm super excited to have you on because my background, my undergrad in school was finance. So I enjoy looking over a good financial statement, making sure things are lining up properly. And to be honest with you, I think this is probably the area where a lot of entrepreneurs are probably the weakest, is they don't want to deal with the accounting side of the business. They just want to know that there's a lot of money coming into their bank account and that they can go do fun things with. But I'm curious to hear how you got into this, how you decided to dive into the retail industry and become an expert in all things financial statements and accounting to the retail industry.
Well, my entry into retail was very organic in that my family is and has always been in the retail industry, but I personally did not work closely in retail. Growing up, I went to college, got my accounting degree, knew that I wanted to be impactful and not just be an ownership of a general accounting firm. So when I was fresh out of college, I did create my first business, founded my first business, and started into several different industries as an accountant and grew into advisory. Made the decision very quickly that the retail sector was the most interesting for me, it gave me just energy, right? Like when you just all of a sudden you go, okay, I connect with these people and I have energy. So I'm a self-learner. So I really deep dove into all the sales, inventory, retail metrics, just self-learned all things retail. Had the opportunity to work fairly broadly from a regional aspect because those were the days where we weren't really able to work nationwide. We've been offered so many more freedoms with our technologies, but regionally became very significant in the retail industry and was able to work boots on the ground with my retail clients, where then I was learning the operational aspects, the creative aspects, everything that you would maybe learn more from an entrepreneurial, being the retail business owner versus the accounting and financial director. And my passion just continued to grow and grow. And as with that, also grew the advisory and the coaching, and just the being able to offer empowerment for retailers is, and just understanding the creativity mindset that they are. It just drove me to everything that She Profits Now is today. Yeah. So it was just that best fit formula. I just knew that it was the area that I wanted to expertise in.
That's a fantastic journey.
Yeah.
And before we hit record on this podcast, you and I were talking, and one of the things that we're going to share with the audience is, like, as you've consulted and coached so many different clients, you have seen a plethora of mistakes that people are making with financials, why they actually end up at the end of the year with a negative profit or zero money in their bank account, even though they have been profitable. So we're going to be talking about all of those things today. But what you prefaced it with is like, hey, actually, like, it comes from like the mindset and like understanding this infinite financial loop. And you kind of have 7 steps that you typically walk your coaching clients through. Maybe that's where we start. What do you think, Christyne?
I love it. That's a great place to start. It will drive a lot of conversation and realism for your listeners. And hopefully they'll have a ton of takeaways and maybe some reality moments where they'll have a reality check of where they are strong and where they can maybe deep dive and learn a little bit more in order to enhance their bottom line and their cash flow in their business, as well as their entrepreneurial professional development.
Awesome.
Yeah.
All right, Christyne. Well, I know you've got something to share on your screen. So
Yes.
Those of you that are listening, make sure you come check it out on YouTube when the video is posted there so that you can see what Christyne is sharing here on her screen. But Christyne, why don't you walk us through this infinite financial loop and these 7 steps?
Okay, yes. So through, like I said, 25 years of being in the retail industry, we outlined that here. It gave me a great opportunity. The time that I've spent with retailers, thousands of retailers, not only being their accounting and their tax advisor and their cash flow management strategist, and the one to make them through help get them through hard times, as well as bring them into lucrative times. It was very quick that I identified that our conversations as client and advisor relationship always leaned into 7 areas of focus within the business. And through those conversations was really bringing the entrepreneur, the retail entrepreneur in your audience is not just retail, but they're creatives. They're creating their product, they're manufacturing their product, they're having to learn not only the manufacturing process, but then the retail process. And what do the metrics look like behind those 2 relationships of coming from creative into manufacturing into retail, and all of the decisions that are necessary when you start to look at each area of decision making in your business and how you can break that down into very bite-sized, actionable decision-making areas that maybe don't seem so overbearing, right? And draining, where we get paralyzed as a creative. Those conversations that I was having, I was going, okay, we've got to simplify this. Let's put it into a 7-step infinite loop. We know that business is always evolving. It's always changing. And one of the mindsets of the creative entrepreneur is that, okay, as long as I know this area of my business, it's good to go. It should almost be on autopilot. Then I've got this area of my business, good to go. Made these decisions, it's on autopilot. And it's quite different, right? Because of the evolution of each of the businesses. I mean, you're growing businesses from 7 to 8 figures. There's a lot happening from a 6-figure to a 7-figure business relative to your financial decisions and the dollars that pass through your business. And then you go from 7 figures to 8 figures. It's that much more complex, and the decisions that you're making. And again, I coach to every single decision that you make in your business has a dollar sign attached to it. And how do we break it down so that we understand the cause and effect financially of those decisions? And that's where the 7-step infinite loop comes into play. Okay. So again, it makes it more achievable for us to create focus, which then creates action, which then creates the results. We can take it 1 step at a time, but continue to loop around in this financial infinite loop to make sure that we're not ignoring areas that we maybe made a decision 6 months ago, but that decision 6 months needs to be revamped because of the evolution in our business, whether it be what we can control or what we cannot control in our environment. Okay. So it allows us to take a step back and always be offering consideration and strategic initiatives towards each area that is affecting our profitability and our cash flow overall. So what you're seeing in front of you is this infinite loop. So in the center of your infinite, right? Like infinite is just that looping and it always goes around. In the very center of it, it is your mindset and your habits. And your mindset needs to be a profitability focused mindset. It needs to be a cash flow efficiency focused mindset. As well as you creatives, it has to also be is how far do we, how wide and how deep do we go with our creativity when our creativity is translating into products that people either do or do not desire, and how long do they desire that product. So the mindset has to come into so many different directions, but no matter what, it has to be that money matters. It has to be money focused, profitability focused, and cash flow focused, or we fall into critical zone with our business. And can it not only scale, but survive, right? So then it comes also down to habit building. So each of the infinite steps that I'll go through here is how do we solidify a healthy mindset around each step, but how do we also build out good economic habits around each step so that we are focused on the data and the data-driven decision-making and the strategies that we can put into play in our business in order to optimize and become more efficient and effective with those dollars flowing through our business. Okay. So that's the center of your infinite loop. And the beautiful thing, if you can see this on your screen, and I'll also make sure that Josh has a screenshot of it that you can loop back to it as well for your show notes. But the beautiful thing about it is that we pass through the mindset phase several times on that infinite loop to really bring ourselves back down to reality and make sure that we don't get lost in the everyday responsibilities of being an entrepreneur and managing the business and working in the business, that we're actually financially working on the business and adding focus to the financial aspects. Because honestly, we all know, Josh, I mean, you've ran businesses, you invest in businesses. If the cash flow is aligned with your goals for your business, everything else comes easier. And so why wouldn't we make that our highest habit forming area that we focus on?
Yeah.
Right.
I think that mindset is extremely important. And I think it makes all the difference. And also having a mindset that is focused on doing, proper financial planning and assessment on your business. I like, it's just a necessary evil. Even if you say like, oh, I don't love it. I don't love accounting. Mm-hmm. And I want that off my plate. Like at the core of it, a business is there to generate profit. And if you're not looking at those P&L statements and identifying like where efficiencies or gaps, that's where your business is really going to suffer. So I'm 100% on board with you. And I want to continue down this path so that we can give some more ideas and insights to these entrepreneurs to help them understand, like, here are some of these steps in this financial loop and why they're so impactful to their business.
Right, exactly. In being creative entrepreneurs, which the retail segment and the design, the brand segment, your customers, your audience are building a brand. When we're creative entrepreneurs and we're focused on our brand and our customer avatar, it is really easy to give ourselves the excuse that we're not good at math. We're numbers dyslexic. My accountant will take care of this. It's just like by the greater powers above us, this will just all work out. We've got to get ourselves into that mindset that our creativity can actually shine through in our financial work as well. As entrepreneurs, we just have to lean into it and see that it actually can be creative and fun. That's probably why you see my brand. If you guys are looking at like, who is She Profits Now? Who is Christyne Grey? I'm a bright person. And it's honestly because I'm also a very creative person. And I bring that into my coaching and my consulting. And so even the slides that you're seeing, very colorful, because I want it to appeal to the creative entrepreneur, because I want to remove the fear of knowing your numbers and the fear of what they're telling you, and I always say you are not numbers dyslexic. You are not bad at math, because guess what? I guarantee you're looking at your Amazon dashboard all day long and you fully understand what that dashboard is telling you when it comes to your sales and the revenue coming through the door. What you're ignoring and make an excuse and creating a different narrative than what is healthy is that you can it'll all work out. You don't have to look at, once the numbers come into the business, what happens with them afterwards. And that's what this loop is all about. Okay. So the numbers that have already come into the business, how are we efficiently and effectively managing them, making decisions around them, like you said, and really being intentional. And what's our purpose towards our profitability? Yep. So when you look at the loop, the very first step of your loop, you come out of your mindset and your habit building, and you're immediately coming into your look back. So your look back in your business is looking back at your sales metrics. How are you accomplishing your sales? What is your average order value? Who are your new, or what are your new customers, and what percentage of your sales is your new customers? And then who is your returning customers? What percentage of sales is your returning customers? And we're going to break this down into several different areas. Those would be the 3 areas of your sales metrics that we want you to be in focus on when you're looking back. Your average order value, just tweaking it a little bit, can, from a 7 to an 8-figure business, can mean a huge difference, right? Like a $10 more average order value on a 7-figure business. Imagine what that would bring in. If you're just focused on average order value, how do we raise it up? Does it mean that we're bundling? Does it mean that we have a follow-up where we get an additional on Amazon? It might be a little bit different, but if you have multiple sales channels, how do you tap into the opportunity to raise your average order value? And then that new customer rate and the returning customer rate, and how often your returning customers are recurring, meaning me as a returning customer, how often am I coming back? I'm not just a returning customer once or twice, but in any given month or quarter or season, how many times are you bring me back into your sales funnel? And knowing and understanding your new customer rates in a percentage standpoint to sales and your returning customers, what does that mean for your longevity of your business? Because when I'm coaching, if I look at a business that has an 80% returning customer rate and a 20% new customer rate, that would seem on the surface as a really good metric, right? Like, hey, we've got 80% returning customers. If you are subscription based, maybe. But all of a sudden you start to have where you have not been managing your inventory, and we'll talk about that from a look back standpoint, or you've been ordering and reordering the same designs and keep pushing out. You don't have, or you're going too deep on any given design and not wide enough in your SKUs. You could actually be hindering your ability at some point to repeat your recurring customers and your returning customers. At 80%, any massive drop could truly be the lifespan of your business. So we want to find the balance between what is new customers, what's returning customers, what are those percentages and how do they balance out, and what is our marketing plan based on that balance, right? And I won't go into marketing, obviously, but those new customer and returning customer rates and relative to the average order value, how much is each of them spending, makes a huge impact when you're looking back to say, how is it that I've accomplished that 7-figure sales metric, and how close or how am I scaling towards the 8-figure? Knowing and understanding gives you the opportunity to pull different levers. Yeah. And then I like the idea of, we always, to just add preface to this, and we'll go maybe a little bit more conversation, that's the sales metrics, is I'm always coaching to the gap. So I always say, you look back, you identify what's working, where's your wins, how do you repeat your wins? How do you identify areas of opportunity where I just said 80% returning customers seems good, but it actually could be critical? You need to then shift and focus on new customers, or add some retargeting, or change some of your retargeting on returning customers into new customers to change that percentage a little bit, get a more balanced mix into who you're bringing through your doors from a sales receipt standpoint. It gives you the opportunity to look back, identify opportunity. Like, you look back, you identify opportunity, but then where do you have gaps? How can you improve? How can you create more efficiency out of your selling and who you are getting a sales receipt from? And what does that look like? So you're looking back, you're making decisions, what worked, what didn't. You identify with where you're at in the gap, and then you plan forward. Okay. And we're not going to go deep into the plan forward yet. Any questions, or do you want to have conversation around? So that's the look back on sales metrics. And I still want to talk about inventory and financial.
Yeah, there's so much to dive into there.
Yeah.
But I think the biggest thing I just want to point out is like understanding how you won and then being able to double down on this is how I won. So how do I do more of that? And I think that like backward planning or revenue map, as you call it, right? And reverse, like looking at, hey, how did we actually get to this point? I think is one of the things a lot of people overlook. And they're just constantly thinking about the future, but not knowing, hey, this is what actually got you to this point, and you could double down on it and see even better results.
Yep, exactly. And then see missed opportunity and make sure that you're capturing additional or through change decision-making or added initiatives, you can capture missed opportunity as well as doubling down into what worked, right? And what you just explained when you just reiterated is you defined the look back, the gap, you're standing in the gap, what worked and what didn't, and then how do we plan forward and what does that action look like? Yeah. So looking back, so that's the sales metrics, looking back then on your inventory metrics, and this is where it gets, since your audience is that creative that is designing and they're building a brand and then they're manufacturing their own designs and then bringing them to retail. That's the bulk of your audience, as we discussed, and as what I've witnessed by listening to your podcast. Your podcast. When we're looking at our inventory metrics, one of the largest areas of, I'm not going to say disconnect, but probably overcommitment is to our own styles, where we continue to go very deep on any given product category or SKU or like SKU. We continue to go deep because as a creatives, we're also very attached to our designs. And so bringing an objective approach to your inventory needs analysis is so important. And inventory planning, when the work that we do with Amazon sellers, even just your seven-figure sellers, we do find that a lot of them aren't inventory planning to the extent that they should be, especially the creative, where we're not going to market and buying and walking away with that product and somebody is sending it to us upon order when you're actually creating it and then manufacturing it yourself. That inventory planning is even more critical because you're actually placing that order. You're trying to decide minimum order quantities. How deep are you going to go on that order? Reaching your minimum order quantities, maybe needing to renegotiate some of those minimum order quantities. When do we not place reorders for that particular SKU and move into another design? How deep, how wide do we really truly go? You've got to be able to understand what your customers' desires are, but also be willing creatively to retire a design, even though it might be your most loved. But it also, there's a lot of power in retiring a design, recognizing that it probably has reached its peak and need to retire it for now. It doesn't mean it can't come back later, right? It's a most loved that can come back later. But when do we offer new designs and just keep the evolution of our brand going and not being emotionally connected to what we love that we design? And that comes down to that inventory planning by category, by design, and for the season. When do we make the shifts and how deep or wide do we go on our designs and what we bring forward for our customers? And that truly does start to show up on your returning customers and your new customer rates, right? Like your returning customers, that's where it can get critical. If I come to your website or your Amazon store and I keep seeing the same thing over and over again, but I've consumed it past my desire, and now you've got inventory stock sitting there. So it's the balance of knowing and understanding. I like to coach planning by season versus planning by month. Is plan by season. What does your product mix look like by season? How deep or wide should you go? And what is your pricing strategy? Especially selling on Amazon, making sure that we're selling and pricing for profitability, taking into consideration our Amazon selling fees. What does that look like? And what are your unique to you standards, right? For markup, because you've got to be able to have a healthy profit margin. We coach to a 40-60-40 rule is with your Amazon fees included. If you can get a 40% cost of goods sold and a 60% gross profit margin, and we've got plenty of Amazon sellers that are doing that, you're sitting in a zone that is very healthy for profitability, because then that allows you 40% for expenses and 20% for profitability. So I coach to a 40-60-40 rule, which gives, 40-20-40, 40% cost of goods sold, 20% profit, 40% expenses. So relative to your inventory metrics, then if you do a quality check on how much you know about your own look back inventory metrics and where you want to, as listeners, where you want to hone your skills, it comes down to what is your turn rate on each of your categories. So what's your inventory turn rate on each of your categories? How many SKUs do you have in each of your categories? Turn rate is going to tell you whether you should be going more wide versus more deep, because we're wanting to maintain a healthy turn rate. That's going to defer, like your specific best in class is the way I coach it. What's your best in class inventory turn rate by category, by season, is going to depend on what product you're selling, right? Like what brand are you in? So there's some variables there that are hard to coach and provide information on in a podcast. So, but your inventory met is your initial markup, and then adding in what is your Amazon selling fees if you're an Amazon seller primarily. What is your maintain markup? How much are you having to discount your product by your customers' love to clear it out of your warehouse so that you can move on to additional products? If you have a high discounting and markdown, that means that you went too deep in that product or that product category, and you need to release it and just be done with it, like move on from it and make sure you're bringing in new, fresh merchandise. And then your turn, right? So initial markup, maintain markup, that's with your discounting, and then your inventory turn rate. That's going to tell you everything you need to know relative to your pricing for profitability, whether you are selling through or not. You're having to discount, meaning did you order too much? Are you going too wide versus too deep, or too deep versus too wide? And are you pricing for profitability? What questions do you have there? And that's a look back. You look back at the data, find the wins, duplicate the wins.
Yeah, I think that's super important. Maybe give us some like case studies or scenarios with those Amazon businesses that you've coached where you've seen like what are the errors that they've made and what are the signals where they are winning and doing well in different categories.
So one of the overarching errors that I do see relative, I'm going to stick with in this answer, I'm going to stick with inventory, right? Because it is our largest investment. And so one of the largest errors and repetitive errors that I am seeing is the investment into inventory. How much inventory are you actually holding at any given time? And maybe even have a line of credit or some debt on that inventory. And how quick is it turning? Because when I will say that 95, the random number, but in my mind, it's a very high percentage. Most of our customers that come into our coaching students that come into our Financially Fabulous coaching program, whether it be in a group setting or on a one-on-one setting, I am finding that they are far overstocked in inventory than they need. A lot of them have 2 to 3 to even a year's worth of inventory, 2 to 3 seasons, or even a year's worth of inventory on hand that is more than what they need, right? So really, truly knowing and understanding what quantity of inventory in dollars do you need to have on hand at any given time, relating that back to what your the timeline of getting that product, right? Like what's the delay in you getting the product once you get the order? Is it 8 weeks once you place your order to receiving it? Is it 12 weeks? Knowing the delivery cycle, what's the minimum order quantities, and understanding how much above and beyond the minimums do you need to actually order or renegotiate your minimums. So overstocked inventory is a huge, huge issue with the creative manufacturing and retail entrepreneur, to the point where I've got multiple incidents where we come in and we coach to inventory quantities. We find the right product mix across the product categories, and we start to downsize inventory in order to increase our inventory turn rates, and we rapidly pay down line of credits because of it. Okay. So
what's a healthy inventory turnover ratio then?
So again, inventory turn rate is also going to depend on the brand and what product you are bringing in. Apparel, for example, so apparel would be a 6 times turn. If you're coming in and you're in the gift market, you're in children's, men's, gift, home, or specialty items, you're going to be around that 4 times turn is what I would be looking for. So a majority of your customer base here, or your listeners, is likely going to be in a 4. I wouldn't hesitate to bring a 4 up to a 5, though, honestly. In the fast demand of consumer and changing needs of consumers and how we change what we want and what we like in the newest, latest, and greatest product, I coach to higher turns. As long as, especially when you're manufacturing, if you can get your manufacturing to around that 8 to 10 week cycle, you could easily accomplish a 5 times to 6 times turn. And I have fashion entrepreneurs who are actually pushing more of a 7 times turn on their decision making, because it is just a fast in and out of what our consumers want. We don't want to be stuck. Yeah.
So what do you do if you have, if it takes you 4 to 6 weeks just to have your manufacturer create the product, and then it's going to sit on the water for another month or 2, right? Until it actually hits Amazon's warehouses. So you're really looking at like a 3-month, 4-month lead time when all is said and done.
So what's going to happen there is when you are planning forward, right? Like right now we're looking at that look back of the 7. What is the inventory telling you? But when you start, we're automatically right now in our conversation shifting to the plan forward that you're seeing on your infinite loop in this conversation, which is beautiful, because right away you're seeing, okay, how do we go from a look back to a plan forward? Right? That's the basis of your question. So when you're starting to plan forward relative to your inventory, you need to have an inventory plan in place. So the inventory plans that are delivered in our Financially Fabulous coaching program, we teach the entrepreneur to create, design, and maintain an inventory plan independent of advisorship, because we want you to be able to plug and play scenarios and really plug and play your unique circumstances, like your lead time that you need on your orders and how long it's in transit. So when you know that you've got, let's just say, an 8-week delivery from order to get that product, you would be looking at, if you're looking at right now to say, I'm going to plan my inventory and start to order for my winter and my spring summer season of 2025, right? Like spring summer, for example, you would look at it to say, I need to here's my inventory plan for spring summer of 2025. That's the plan. That's how much inventory I need. Now I back into what are my order dates based on lead time that you need. Okay. So it all comes down to having that foresight of knowing and understanding what your inventory needs are on that season that you are ordering for, and then backing into, like I said, the delivery dates, just to repeat it in a different way.
Yeah.
But it all comes down to an inventory plan. So when you're planning forward, this is actually, it's delivered with, it's part of our Financially Fabulous coaching program. When you are planning your inventory forward, you're looking back, you're identifying how did your inventory perform. And maybe you're at a 2.5 to a 3 times turn. You want to get better and you want it to be a 4.5 to a 5 times turn. Maybe your margins aren't, your initial markup was a little bit lower than best in class for you. We would help you determine that, because again, there's different guidelines based on what industry you're in and what products you're selling. But maybe your initial markup needs to have better pricing at the front of that retail price. So that would come down to identify that you maybe need to go back to the drawing board and do some renegotiating with your manufacturer so that you can get better initial markup. Then maintain, like I said already, it is a direct reflection of you bought too much product. You're discounting it to get rid of it. You're buying your customers' love. So once you know those metrics from a look back standpoint, how you are performing, we go into that plan forward phase where we're basically, if you think about it from just planning your roadmap forward financially relative to your inventory, you put in your coordinates. What do you want to accomplish? I want to accomplish a 5 times turn. I want to accomplish a 33% cost of goods sold on my initial markup. I want to stay within let's just say a 5 to 7 to 8% discount. How do I do that? What does that mean when I'm buying inventory? So that desired and planned turn rate at a 5 times turn with, let's say, a 33% cost on our product, that will give you exactly where you cost dollars that you need to be spending in inventory for any given season and month. Then that's how you back into your order dates.
Interesting. Yep. I like that. All right, Christyne, keep walking us
All right.
down.
So your look back, then let's just touch one more area of your look back. We've talked about sales metrics and inventory metrics. We can't forget financial, right? Like sales and inventory is coming out of your point of sale or your channel selling, wherever you're selling your product. That's where that data is coming from. But then we've got to also take a step into, are we reviewing and understanding, and can we rely on the financial statements that either we are producing in-house or we have outsourced and our, procured accountant, our engaged accountant is producing for us? Do we understand them? Can we rely on them? Are we getting them on a timely manner? And are they in a retail specific format that actually tells us the story of what our business is doing financially? So your financial metrics from, here's some more paper and pen, right? So take notes. So on your financial metrics, what you're looking for from a look back standpoint is your cost of your top level of your financial statements is obviously going to be your revenue, less your discounts, less your refunds, less your cost of goods sold, less your Amazon and your channel selling. What is your cost of sales and what is your gross profit margin? And is that in a healthy rate? That's that initial markup, maintain markup concept on our inventory. Are we at a healthy rate? So when we're coaching best in class, 40, 20, 40, we want a 40% cost of goods sold to our selling, and our net sales, right? Gross sales minus discounts minus refunds equals net sales. We would like our cost of sale to be 40%. That gives us a 60% gross profit margin. So when you're looking at your financials, can you see that on your financials? Are they in a format that gives you that data? And if they are not, you need to either speak with your accountant to get your financials delivered to you in a retail specific format, and hopefully they understand your industry, or make a shift so that it can be in a retail specific format and with somebody that understands your industry, because we speak a different language. You can't have a farmer tax accountant, an accountant, like farmer, somebody that comes in there manufacturing, farming, all professional services and retail. They're not going to understand our language and what we're looking for. So that gives you your gross profit margin on your financials. Then take a look at your expenses. Are your expenses on your financials just in one row? Just a list of expenses, and they're all alphabetized, but they really don't tell a story. Yes, they say, how much am I spending on advertising and rent and compensation, but do you know if you're in a healthy range in any given expense category? So pen to paper again here on a note, and again, we can put these in the show notes for you guys, is when we're organizing here at She Profits Now, because we are an accounting firm as well. We're a coaching and advisory firm. Our accounting division and our tax division supports our coaching and advisory because we need the data, which is this conversation. So when you're looking at your overhead, we're looking at that 40% best in class. We're always protecting 20% profit no matter what. If your cost of goods sold is higher than 40%, that would have to shave off of your operating expense allowance, because we want to protect 20% profitability, right? So you've got 80% play between your cost of selling and your expenses. But when you look at your financial statement, if it's just a list of alphabetized expenses, they mean nothing to you. How do you make decisions? Where do you cut back? Where's the guide for you from a bit data-driven decision-making and strategic standpoint? What we want to do is we want to organize your expenses into 5 categories. And those 5 categories are your selling expenses, which is going to be your selling expenses is going to be your retail supplies, your shipping costs or your shipping supplies, anything it costs to get the product into the consumer's hand and provide your brand experience. It is going to be your marketing expenses, your advertising. It is going to be your point of sale and your technology costs for selling. It is going to be any design and branding and website costs. That's all going to be underneath your selling expenses. So we want to look at our selling expenses and say, what does it cost for us to actually maintain and deliver our brand experience, as well as get our product into the hands of the consumer? And with that selling expenses, I would put that at about 10%, unless you don't have the occupancy need. Like if you're storing your products at Amazon and you don't have a lot of occupancy and warehouse expenses, or a lot of your on your online space, right? Like your brick and mortar, your where you're residing to sell isn't physical space. We shift from occupancy up to selling. So we can have some shift in some of these numbers, right? There's flexibility here, which then leads me to occupancy. Your occupancy is your rent, whether it be retail space, warehouse space. It's going to be your repairs and maintenance on that space, your utilities, your security. That's your occupancy. That should be at 13%. And again, if you are warehousing at Amazon facilities, you wouldn't have a lot of warehouse space. So you might be at a low percentage in your occupancy expense. That 13% can then be shifted up to selling. So you'd raise your 10% by the discrepancy there, right? Like you're just reassigning it because your occupancy space is at Amazon. That is your selling expense, right? Then we've got your compensation. So your team compensation, your officer salary as an entrepreneur, your operational role, what you're paying yourself for operational role, that if you weren't doing it, you'd have an employee for it. All compensation would be 13%. That's benefits, taxes, and wages. 13% is a healthy margin. And then you've got your admin and your operating. We're going to reside right around that 4% there. And again, you might have to blend those numbers a little bit differently between those 5 categories. But the goal is to get them to be 40% as long as you have 40% cost of goods sold. 80% total between the two. So you can shift. So I'm just giving a guide, right? So when I coach to a 40, 20, 40 cash flow management rule, it's protecting the middle, that 20%. Okay. So that's that financial look back. You've got to be able to rely on your financials, your profit and loss, to tell you where you are or are not overspending money. Your selling expense category, that's an investment category, right? Like we never want to shortchange our selling. And all too often, when we talk about pitfalls and areas that I see concern, all too often, I'm seeing entrepreneurs overspend in compensation, overspend in occupancy, and then they are strapping the success of their selling and they're not able to advertise like they should, which is where we get in that holding or that plateau pattern on our 7-figure to 8 figures, because we're not investing and instead we're overspending. Okay.
Yeah.
So I do encourage the 40% spend if we can, and just settle with the 20% profitability if you can, because that gives you the profit. If you're lean in any other area, take the difference of that 40% where you're lean and get it into a really good strategy for marketing your business, because that's investing in. Yeah. Or professional development, right? Like sometimes you got to take a step back, go into professional development, know and understand where you're going to be investing and is it good investment choices, then invest in. But commit to that 80% cost of goods sold and operating expenses, operating investment, we're going to call it that, operating investment, to protect and grow your 20% profitability. Yeah, because we can't strangle our business through resources. Yeah, but we've got to allocate them accordingly. A lot of time on the look back, but it's really truly part of that planning forward, right? So in that discussion right there where I was talking about the 40, 20, 40, that's a lot of your planning forward. If you look at your financials and you have them organized into the 5 categories and you understand your percentage of spend in each of your category relative to your net sales, that's your look back. You see what's working, what's not. Where do you need to make business decisions, spending decisions that are at a healthier balance? That's part of your planning forward. Then you map it out. Where are you willing to spend money? So we coach to an up-level rule when it comes to our financial metrics, is when you are looking at how you're going to spend your financial resources after you've made the sale or you've brought capital into the business, is that spend going to up-level your business overall and its ability to reach your goals? Is it going to up-level your ability to make the sale and invest into the systematic and strategic sale that continues to grow? And does it grow and up-level you as an entrepreneur so you can continue to expand this business into its vision? That's that up-level analysis. And if you say no, it doesn't meet any up-level criteria, then it's a wasteful spend. You've got to reanalyze why you're spending it. Okay.
Yeah, makes a lot of sense. Now, Christyne, we're coming up on time here. So my questions would be, for you, what are some quick hitting wins that you could give for our audience of, hey, I see entrepreneurs making a lot of these mistakes in the e-commerce industry. Can you rattle off a good number of some specifics that they can do today to improve some of their financial metrics?
Yes. So like I said, get control of your inventory. How much inventory do you really truly need to have on hand at any given time through each of the seasons? That's so important because that is your largest investment. That's likely why you have debt. If you do have debt, make sure that you're living in that 40-20-40 cash flow management rule, that you are protecting your 20% profitability. And if you don't have 20% profitability, or it seems like a far stretch, really deep dive into why you do not. Is it at the cost of goods sold level and your markup strategy and your selling tactics, your percentages and your metrics, or is it at the expense level? Where can you trim? And how long will it take for you? If you were to project it out, how long will it take for you to get there? So that leads me to the final is projecting. It is so important to plan your inventory, which is projecting it out, plan your profit and your cash flow, which is, that 40-20-40 profit and cash flow planning that we talked about. Plan it out and identify where your cash flow is each period over period. So in our Financially Fabulous coaching program, we have a cash flow projecting tool that takes your plan forward to your revenue mapping, to your inventory planning and your expenses, and literally will show you that if you start this month, if you go into September and start it with, $50,000 in the bank, where do you end next August? With what you have already mapped out. So strategic planning and projecting is so important, and allow yourself the opportunity to plug and play scenarios. If I do this, if I make this decision, what is my calculated outcome financially versus this secondary plan B decision? What is my calculated financial outcome? Yep. And don't be scared of the results. That's the big thing too, is don't be scared of deep diving into the number and knowing and understanding the results, because that's where the power and the empowerment is.
100%.
Yep.
Christyne, excellent takeaways here. I love to leave my audience with 3 actionable takeaways from every episode. So here are the 3 actionable takeaways that I noted. So number 1, you've got to be able to have that financial look back period. And you talked about the, 5 different buckets that you should classify kind of like your expenses into, so that you can actually drive business strategies from the insights that you glean from those buckets. For Amazon specific businesses, I would argue there's even 3 main levers that you should really be focusing on that are going to move the needle significantly. So the 3 buckets that we are constantly monitoring is number 1, what is our COGS, cost of goods sold, as a percentage of sales? And so this is the cost of just how much I'm buying the product from my manufacturer, and any tariffs, any, shipping costs related to bringing that product landed here in the US. So what are my landed COGS as a percentage of sales? Is that number increasing or decreasing year over year? Okay. So that's number 1. Then number 2 there on that second bucket is we are measuring our FBA fees. So you've got the 15% referral fee. That's locked in. Doesn't matter what you sell a product for, you're paying Amazon at least 15%. Yeah. But those FBA fees, which Amazon is only increasing the fees year over year at this point, you want to make sure that you are adjusting to these FBA fees accordingly by raising your prices or finding better products with higher profit margins. So year over year, even though Amazon's raising their fees, you shouldn't just be losing 3% year over year as Amazon raises their fees. You need to make sure that you're adjusting your product categories. You're making sure that you go in and you're raising prices accordingly. And as long as that FBA fee percentage stays flat year over year, or maybe improves year over year, you know whether you're winning or losing. And then the last big bucket that I think that Amazon entrepreneurs really need to focus on is going to be the total advertising cost of spend or sales, which is your tacos number. Okay. And so that I've heard of varying ranges, people spending 20% of their sales just on advertising, and as little as, 3, 4, 5%. I think there's a fine balance for every business. but it's measuring those year over year changes, because those three buckets, the COGS, your FBA fees, and then your Amazon advertising, I'm going to argue that's going to make up 66% of your entire spend for your business. So you're not left with much after that. If that's where all your money's going, what are the actions you should be taking is focusing on what are the levers I can do to decrease my COGS, lower my FBA fees. Product packaging is one of those that you could tweak. Could you go from a large standard size item down to a small standard size item? On the advertising front, are there new advertising campaigns that might have a better return on ad spend for you? And are you reinventing things, or did you just hire an agency and you're just crossing your fingers that they continue to operate things for you? Those are the three key levers in any business. So those are the three actionable takeaways that I would leave for our guests is like, what are you doing in each of those three big buckets that actually drive significant expenses to any e-commerce business? Would you add anything to that, Christyne?
The only thing I would add to that is see if you can try to protect that 20% profitability, because that 20% is what is going to fund growth in your inventory purchasing, the inventory you keep on hand, paying you profit distribution, taking on any additional risk in your business for goals that you've set, right? Like visionary changes, and paying you as the entrepreneur. So it's balancing it.
I love that. Totally agree. And I think the margin squeeze is on right now. You have overseas competitors lowering prices. It's a race to the bottom. But as much as you can do to protect that 20% profit margin is really important, especially if you want to be able to fund new growth, which comes from investing in new product launches.
Exactly. R&D.
Christyne, I love to ask every guest the following three questions. So here we go from the top. Number one, what's been the most influential book that you've read and why?
Most influential for me is Atomic Habits, because I like coordinated chaos. And so I constantly refer back to it when I'm going, okay, Christyne, you got to reel yourself back into that coordination. Yep. Atomic Habits. I just feel like it's a read and overread when we feel like we are spread too thin or disorganized or chasing shiny objects, whatever it might be as entrepreneurs, because opportunity can get us running in too many different directions. It always reels me right back in.
That is a fantastic book recommendation. It's one that you could revisit every 6 months and find something new in
because
there.
You read it differently in whatever phase you're in or whatever you're experiencing personally and professionally. Yep.
Great. Question number two, what is your favorite AI tool or software tool that you've been using that you think other people should know
I'm
about?
loving ChatGPT and the pro version. I really am. That extra $20 a month gets you so many creative tools as well as fun tools, but I've lovingly called named mine Linda. So my ChatGPT and I are really closely connected at this point. So, yep.
Give me some use cases that you've been using.
For me, from a creative content standpoint, because I am so customer facing that when I sit down and I'm working on content or blogs or really just training and coaching material, I know what I want to say, but it's hard for me to put it into full scripts. And so I'm usually just a mind dump into my ChatGPT on all the things that I know. And it just gives me a very eloquently spoken output that saves me a ton of time. It's trained for my voice at this point because I've obviously go back and rewrite it and adjust it. And that's what I love about the pro version is it knows my voice. But the more I mind dump into it, the easier it is for me to extract and provide my own knowledge and insights and expertise for my consumer in my own voice.
Love that.
But you got to work at it, right?
Yeah.
It's just not automatic because you can get some pretty shoddy results unless you spend some time with it and give it enough insights to be your own voice. Yeah.
Agreed. All right. Final question. Who is somebody that you admire or respect the most in the e-commerce space that other people should be following?
Okay. I know this is really cheesy for me to say this, but I'm loving your podcast. I really am. I found your podcast. I'm loving it. I love the insights. I love that you have a very embedded approach with the e-com business in that you've experienced it. You've built your own business. You are not only coaching, advising, and investing, but you are living it as well. and the diversification of your guests, I'm loving it. Like I said, I know that's probably a cheesy answer on your podcast, but it's fun and it's new for me. And so I'm enjoying it. I can't recommend it enough.
Awesome. Well, yeah. Christyne, I appreciate it. Your check is in the mail first.
Yep. No checks. I think we can honestly talk all day long. So this has been a good experience. I appreciate it. We didn't even get to all of the 7 steps. You guys saw them on the screen. Yeah, we'll make sure that they're in the show notes, but we touched on a lot of facts though.
So Christyne, I know we weren't able to go into everything. So if people want to learn more, where could people go to find more about you, your coaching programs, et cetera?
Come to sheprofitsnow.com and you will find our professional services there, as well as our Financially Fabulous coaching program. If you want to have a one-on-one chat, there's a link for you to jump onto my schedule for a discovery call or even just a profit breakthrough session. And it might be the easiest and the best way to connect so that we make sure that we have a right fit scenario.
Yep. Awesome. That's wonderful. All right, Christyne, thank you so much for your time today. It was a pleasure having you on the show.
Thank you. It was wonderful. I appreciate it.
Thank you for listening. Visit ecommbreakthrough.com for more information. If you've enjoyed today's episode, the best way you can show your appreciation is by clicking the subscribe button and quickly leaving a review. See you again next time.